to the markets now, which are rebounding following yesterday's sizable sell-off. Here with more on today's action and how to position now is Tom Hulick. He's the CEO of Strategy Asset Managers. Tom, am I right here that the market seems to have sort of played past some of the data that might be otherwise worrisome? Higher interest rates, fewer interest rate cuts this year, inflation that is proving harder to get down to that 2% level, even though it seems sort of quiescent in the 2.3, 2.5 area?
Well, thank you for having me.
You're welcome.
One of the things that we look at as an active manager are kind of the signals that some of the earnings reports that are coming out right now. Take, for instance, Microsoft and Google and Meta. They had strong earnings reports, and we cover most of those Magnificent Seven stocks. But the data that we see on the economic side is still quite strong. You know, the economy's doing well. We see the labor market still being pretty tight. Inflation numbers are sticky around the 3%. But we see a strong market going right ahead of us.
Even here, and being more specific about it, you had personal spending rising 0.8%. More than what we saw for the wages of a rise of 0.5%. But the personal savings rate fell pretty significantly here. What does that tell you about where consumers are putting their money and where there might be investment opportunity? You
know, Contessa, we're telling our clients right now to be wise with where they have their money. For example, we counseled our clients, as an active manager would, on taking advantage of savings rates being at 5%. However, as you know, interest rates will eventually start to come down, and we have to find smarter places to move your money. For example, on the active management side, we will counsel our clients into going into the technology sectors, maybe the healthcare sectors, the industrial sectors, any of the sectors that really have pricing power right now. But we do try to take our clients into areas of strength.
Maybe a couple of your larger holdings. Well, the ones that are in the most customer accounts.
I would say that some of our larger holdings would include something like a Google, a Microsoft on the technology side. We like Intuitive Surgical,
which is a robot surgery.
Ticker symbol ISRG, right? That's another strong one for us. We like Constellation Energy brands, which is a nuclear power plant company.
Why do you like that?
Energy is important. I mean, it used to be a dirty word, but if you see all the data centers that we have out there sucking up all the energy, we've got to find alternative sources to feed the supply that's in these data centers. Constellation Energy is one of those companies that can help out.
The theme that runs through Constellation Energy, Intuitive Surgical, and of course the big guys, Meta, Microsoft, Amazon, that you own, is the exposure and the way that they will capture the potential of artificial intelligence.
It's the big theme right now. AI is so important. If you don't incorporate AI into your company, you're going to be left behind. AI is going to drive earnings efficiencies for all companies, especially companies in the industrial sector like a CEG, or maybe even Intuitive Surgical, taking advantage of the healthcare opportunities that are there to make surgeries more efficient.
But is that a question now that portfolio managers and financial advisors are going to have to be able to explain to clients now is, okay, so you like consumer goods or you like this particular biopharmaceutical services company, but here's how AI plays into the future of their business. Are they going to have to understand the potential for these companies to grow based on AI?
I think just as we adapted to using a cell phone years ago, or just evolved in the technology sector, AI has been transformative. It's allowed companies to become, as I said, more efficient. But if you look at the advantages of using this type of technology down the road, we need to continue to lead as the United States, be an innovator in these areas. And AI spending in the United States alone is about 7 times more than any other country in the world at this point. That's a really staggering figure because we want to be first. We want to be leaders out there. And AI is going to shape our technology and innovation out there.
Talk to us a little bit about Meta, if you would. We had our stock draft last year. I'm sure you know about it. But it was the first choice. It was the first pick off the board yesterday. People had been a little bit critical of Meta based on I guess, forward forecasts and the idea that they're going to have to do a lot of capital spending associated with AI. I see capital spending as a good thing. It means they're investing in their business. It may not help them next quarter or the next couple of quarters, but in the long run, you want companies to be investing in the technologies that they think are going to benefit them.
I agree. I think the capital expenditure item for Meta was necessary. I think that Zuckerberg saw things in the future that to remain competitive. We have, first of all, we own Facebook. We have clients from Facebook. We have former clients that were at Facebook. We've owned this stock for a long time. We believe in the direction of AI, and that just shows that capital expenditure that Meta did was necessary to remain competitive.
Tom, thank you very much. Appreciate it.
Thank you, Todd.
Tom Hulick.
Thank you, Contessa.
Nice to see you.